Somewhere right now, a person making 6 figures a year is drowning in debt. And somewhere else, a person who owns almost nothing outright, no house, no car paid off in full, is quietly getting richer every single month. Both of them are in debt. Only one of them planned it that way. That's the part nobody tells you. You grew up hearing the same rule over and over. Debt is bad. Pay it off. Avoid it. Debt is the thing that keeps regular people trapped, working jobs they don't love, sending a chunk of every paycheck to a bank that already has more money than it knows what to do with. And for most people, that rule is correct. But some of the wealthiest people on Earth do the opposite. They borrow money on purpose. Not because they're careless, not because they can't afford to pay cash. Because used correctly, borrowed money can become a tool that multiplies what they already have.
So how does going into debt make someone richer? Let's break it down. Picture a $500,000 rental property. A regular buyer might save for years to pay for it in cash. An investor thinking like the wealthy does something different. They put down $100,000 of their own money. They borrow the remaining $400,000 from a bank. Now here's where it gets interesting. That property doesn't just sit there. Tenants pay rent every month. Some of that rent covers the loan payment. What's left over is profit. And over time, if the property increases in value, say it eventually sells for $600,000, that $100,000 in gain doesn't just belong to the bank, it belongs to the investor. Which means a $100,000 investment just turned into a $200,000 gain, once you include the equity from paying down the loan and the appreciation. If they had bought the same property with $500,000 cash and it rose to $600,000, that's still a real gain, but it's a smaller percentage return on the money they actually put in, because all $500,000 was tied up instead of just $100,000. This is called leverage, using borrowed money to control a larger asset than your own cash alone would allow, so your own capital works harder. And to be clear, this is a simplified, illustrative example. Real estate can lose value, tenants can stop paying, interest rates change. This is not a promise, it's a mechanism. But here's where things get bigger. This same principle doesn't just apply to buildings. Businesses use it constantly. A company doesn't need to have $1 million sitting in the bank to open a second location, buy new equipment, or expand into a new market. Instead, they borrow the capital. They use that borrowed money to generate more revenue than the debt costs them. The difference is profit. A factory owner might borrow money to buy a machine that produces more product, faster, at lower cost. A restaurant might borrow to open a second location in a busy part of town. If that new location earns more than the loan payments cost, the owner comes out ahead, using someone else's money to do it. Now imagine what happens if that same logic gets applied irresponsibly. That's where most people get it wrong, because not all debt behaves the same way, and this is the part most people overlook. There's a difference between debt that builds something and debt that just disappears. Borrowing to buy a rental property that generates income, that's productive debt. Borrowing to buy equipment that increases output, productive debt. Borrowing to expand a business that already has customers lined up, productive debt. But borrowing to buy things that lose value the moment you own them, with no plan to generate income from them, that's a different story. A vacation on a credit card, a car loan on a vehicle that depreciates the second you drive it off the lot. That kind of debt doesn't build anything. It just costs you every single month until it's gone. And here's the honest truth. Even good debt isn't automatically good. It depends on the interest rate. It depends on cash flow. It depends on whether the borrower can actually handle it if things don't go as planned. Which brings us to the part almost nobody talks about. The same tool that builds wealth can destroy it just as fast. Go back to that $500,000 property. What happens if the market shifts, and instead of rising, the value drops to $400,000? Suddenly, that investor's $100,000 is gone, wiped out. Because they only had $100,000 of their own money in a $500,000 asset,
A 20% drop in property value can erase their entire investment, while someone who paid in cash would have lost the same 20%, but still have $400,000 left. That's the danger hiding underneath every leverage strategy. It doesn't just multiply gains, it multiplies losses. Now add real-world pressure. Interest rates rise, and suddenly the loan payment is higher than expected. A tenant moves out, and the rental income stops, but the mortgage doesn't. A pipe bursts, a roof needs replacing. Expenses that weren't part of the plan show up anyway, and the loan payment is due either way. This is how leveraged investors get forced into selling, not because the asset was a bad idea, but because they ran out of cash before the plan had time to work. In business, it's the same story. A company that borrows too aggressively can find itself paying more in interest than it earns in profit every single month until it collapses under its own debt. Debt doesn't ask if you're ready. It just asks to be paid.
So which is it? Is debt the secret weapon of the wealthy, or the trap that ruins everyone else? The honest answer is, it's both. It depends entirely on how it's used. Wealthy people who use debt successfully aren't reckless, and they aren't fearless either. They understand exactly what they're borrowing for, whether it has a realistic chance of generating more than it costs, how much risk they can actually absorb if things go wrong, and just as importantly, when the numbers stop making sense and it's time to walk away. That's the real difference. Not debt is good or debt is bad. It's understanding that the same tool which can build an empire can just as easily tear one down. The question was never whether to fear debt or chase it. The question is whether you understand it well enough to know which one you're holding.